Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video we are looking at two companies in the financial services. These two companies were actually requested by a community member. So what I want to do is I want to dig deeper and just find out everything we need to find out. Not too deep, but just to give you kind of overview of everything about these two companies, and then obviously you can go away and do your own research. But before we do that, can you please give the video a like, because it takes a lot of time to prepare, especially with, obviously I have a full-time job, I've got a family. I keep saying these things as not an excuse, but I genuinely enjoy doing these videos, and obviously interacting with the community. It helps me a lot, and I hope it's helpful to you as well. But at the same time, it will be really nice if we can grow this channel to where I want it to be, inshallah, in the next couple of years. So yeah, just to give the videos a like, subscribe to the channel if you haven't already, share with your family members and so on. It's so surprising. Like every time I go out and we meet new people or new family members that I haven't seen in ages and so on, and we talk about what have you been doing, and it's so surprising how many people do not even think about the stock market whatsoever. How many people don't even think about the general property development side of things that people know about, but when it comes to investing in the stock market, genuinely don't really care. The younger ones always talk about cryptocurrencies, obviously, right? But the older generations, and I'm saying older, and I mean genuinely people that are like 25 to 35, that age group, right? People that have started working and earning some good money, some of them have not even thought about, oh, I'm saving for deposit. All right, cool. So where's your money right now? Sitting in an account, basically losing about 10% every single year. So why don't you invest in the stock market? Oh, really? Is that halal? I'm like, yes, it is. Just go and do your research, find out. And then again, I gain a few subscribers that way, I guess. So yeah, alhamdulillah, it's one of those things just to share with your family and loved ones, obviously. Like I've always said to you guys, I'm just sharing my journey. What you see right now is my portfolio. I'm definitely not a financial advisor, but I'm just sharing my journey, right? So let's start looking at what's happened yesterday in the earnings reports. So we'll talk about 3 of those earnings reports, and then we'll move on to these 2 stocks that we need to look at today. So the 3 companies I want to talk about is Microsoft, Visa, and Texas Instrument. They've all reported last night after the bell, and this is what's happened. So with Microsoft, okay, they actually beat their expectations. So basically $2.35 per share, that's what they've made. $2.30 was the expectation, okay? So that is perfect. When it comes to revenue, was $50.12 billion. They were expecting less than 50, so that's again a good thing. But the issue comes around here. So okay, so what has happened is the stock is down quite a bit, I think today, 4-5%, whatever it is. The market is still not open, but the guidance was $52.35 billion to $53.35 billion, right? So that's basically it. So that's what they're expecting. But the analyst, okay, said their expectation was $56.05 billion. So for that reason, they give or take, there's about 2 billion differences in there. And for that reason, the stock's down quite a bit. And this, we're talking about a company that actually has basically grown a lot in terms of their top line and bottom line. So looking at this, the cloud service, the cloud revenue was up about 24%. Okay, when it comes to revenue and productivity and business processes, which is basically all the office package and so on, grew 9%. In terms of revenue, intelligent cloud was about 20%. Okay, so everything else was basically perfect apart from the revenue in terms of the personal computers, and they've told us this while back. Okay, $13.3 billion, and indeed basically slightly decreased from where it was last year. And for that reason, the stock's down quite a bit. But when it comes to top line, bottom line, they beat, but the guidance was actually slightly lower. And for that reason, it is down. Now, should it be down? I genuinely couldn't care less right now, because, some people have these analysts have their own expectations, and they can say whatever they want to say. But in the end of the day, it doesn't change the fundamentals of the business, right? So the business is still doing well. If the business is still growing 20% when it comes to their certain section of their revenues, and that's not the entire business itself, okay, to me, I'm happy with that, and I'm genuinely right now couldn't care less what basically these analysts are thinking. And the fact stock's down about 5% and it's been down quite a bit lately, that's a great opportunity for investors who would want to add to their portfolio. And the next one is Visa. Visa is absolutely amazing. It beat both top line, bottom line, and definitely increased their dividends as well. Okay, so they're increasing their dividends. I can't remember how much, but they're increasing their dividends and they announced a $12 billion buyback. Now, that to me is a great business, right? So they beat the top line, so the EPS and basically top line to the revenue, and the bottom line, as well as that, they've actually increased it. That stock should not be basically up just that much. In fact, it'll probably up more than that. Hopefully it will be more than that, okay? Because what else do you need to do to actually get at least a 2-3%, if not 5%, pop in the basically when it comes to the stock price? Although I couldn't care less about the stock price, but that's a very good news, the fact that they're buying back their own shares, they're increasing that dividend, they're actually doing well so far. That tells me the economy is not as bad as we think. And the final company I want to talk about is Texas Instrument. This is a company that I'm really interested in, possibly be adding to the family portfolio. But EPS and basically revenue were both beat. Okay, it was down 4% because again the same thing for the guidance. Okay, so they came out and the guidance basically was slightly lower than basically what the analysts were expecting. So very similar to what's happening to Microsoft. So again, another great company that's down right now. So yeah, there's so many things going on out there. Most important thing that you think about your long-term plan and you focus on that. Okay, right. So let's have a look at these two companies that we're talking about. The first one is SPGI or S&P Global. This is one of the ratings companies, the largest credit rating company in the world. It has over $100 billion market cap. It's a financial services. So they don't have anything to do with basically dealing with money. They are basically rating companies. So they go to other companies, the banks and so on, and they look at their balance sheets and then they rate them, right? That's all they do. But they obviously are making it simple and simplifying it, but obviously they do a lot more than that. So the company currently is trading $312 per share, EPS of over $13. Market cap $104 billion. It has a wide economic moat and it has a beta of just above 1, which means it's a little bit more volatile than the market itself. PE ratio 23. I've not seen this stock trade below 30 recently, so that's actually quite nice to see. But the sector, because it's full of banks and so on, right, is just a very, very low PE in that sector anyway, generally. Price to free cash flow 31. So this is where normally it basically is 30 and above. That's what I've seen with this company in the last 4 years. Annual dividend yield, we're looking about just above 1%. 5-year growth rate of 16%. They have increased this dividend for 48 years. Okay, so that means 2 more years they will be a dividend king. Payout ratio 26%, dividend safety 99%, free cash flow $2.5 billion. And this is important for us, especially right now when there's so much uncertainty going on. If a company has a basically free cash flow, they can increase that dividend if they want to, or just to keep it the way it is right now. Okay, because their payout ratio is very, very low because it's only 1%, right? But it's important that the company has some free cash flow so they can pay off their debt if they need to. They don't have to go to the bank and get in more debt and so on, right? They can actually buy back their own shares like Visa was doing right now. They can increase that dividend. They can actually acquire other businesses. So they can do a lot with that money. So it's very important that the companies that you're investing in has basically positive free cash flow. Some companies out there will have right now negative free cash flow, and that's something you really need to be careful, especially in this environment that we're in. If we're heading towards recession, okay, doom and gloom and so on, you need to make sure that is in basically companies that you own in your portfolio have excellent free cash flow. Profit margin 38%, operating margins 55%, return on equity almost 17%, total return in the last 10 years we're looking at almost 20%, and current ratio is above 1. So that means the company has enough assets to actually pay off in any liabilities in the next 12 months. And the next 5 years, they're expecting every single year the 10% growth. Okay, in terms of earnings, current share price of the stock is $312. Fair value, according to Simply Wall Street, is 310. And that for that reason, it's a little bit overvalued at the moment, according to them. Fair value according to Morningstar is $380 per share, which means about 18% discount right now. Total their price target for tip rank for the next 12 months, okay, is 389, and that gives you about 25% upside right now from where the stock is right now. And according to tip rank, is actually strong buy. For me, it's definitely a buy because I own this stock in my portfolio. I've only got 4 shares and I would love to add to it, but it's been going up and down, and there's other companies that I was really interested, but now I'm in the negative. Okay, and some of that is because also otherwise I would have been almost 7% in the red, is because of the FX impact is actually helping me quite a bit. Okay, so yeah, so that's the first company. Let's keep looking at the total revenue and so on. So we're looking at total revenue in the last 5 years from 6.2 billion to 6.6 to 7.4 to 8.2 to right now 9.5. So it's really heading the right directions. And when it comes to the cost of that revenue, it's actually kind of consistent. It hasn't gone up a lot, if you like. So a lot of that money is actually going to the gross profit. And after they paid all their taxes and so on, the net income, so the take-home money, 1.9 billion to right now $3.6 billion, which is really nice. Okay, and then you've got EBITDA of $3 billion to now $4.4 billion. But when it comes to free cash flow, again, is really important. We've already seen how much they have right now. We're looking at 1.9 in 2018, right now to $2.5 billion. So that has increased nicely, but 2019 it went up. 2020, even though COVID and all that stuff, it still went up. 2021 it went up. Right now in the last 12 months, trailing 12 months, we're looking at $2.533 billion, which is actually quite good. In terms of shares outstanding, they have actually issued more shares recently, which is stupid. I don't understand why they've done that, because they have been basically buying back their shares, but they have actually diluted the shares just in the last 12 months, which I do not like. Okay, but it is what it is. It's one of those things, right? So maybe they had other debt to pay off or other things they needed to do. And finally, we're going to look at from Sharia compliance side of things. One of you asked me when it comes to the business activity and so on, what is it? So in terms of percentage wise, so what are we looking for? We're looking for business activity like less than 5%. So less than 5% of their business could be okay non-Sharia compliant. Ideally 100% would be perfect, but less than 5% is basically what's expected. Less than 30% when it comes to interest-bearing debt, and when it comes to interest-bearing securities is also less than 30%. So less than 30%. What I mean by 30% is that 30% of the market cap and to 30% of the market cap. So it's an easy calculation to do. So yeah, that's basically it. So that means the company is absolutely fine in terms of Sharia compliance side of things. The second company we're looking at is the almost sister company. They do exactly more or less the same thing when it comes to analytics, research and data and so on. Again, financial services. Currently trading $257 per share, EPS 9.25, market cap of $47 billion. So it's a half the basically the company and half the market cap when it comes in comparison to S&P and global. It has a wide economic moat and it has a beta that's slightly higher than basically when it comes to in comparison to S&P global. So PE right now is 27, so it's a little bit more expensive. Price to free cash flow right now is 37 as well. It's seems very expensive stock right now when by looking at just these metrics here. Annual dividend yield of just 1%, 5-year growth rate of 11%, dividend growth streaks of 12 years in a row, and payout ratio 28%, which is quite nice. Dividend safety 83%, free cash flow $1.2 billion right now. So it's not a lot, but it's actually they've got some positive free cash flow there. 28 or 29% profit margin, operating margin almost 40%, return on equity 70%, total return the last 10 years almost 20% as well. Current ratio we're looking for 1.4, which is basically perfect because we're looking for anything above 1. And the next, basically the growth side of things, the next 5 years, according to Yahoo Finance, is 0.2, which is not a lot if you think about it. So yeah, that's basically what it says, and that's what I've got from Yahoo Finance. I'm sure there are other websites that we can double check. Yeah, just according to Seeking Alpha, okay, so this year-on-year growth basically will be minus 11%. but 2023, December 2023, they're expecting the earnings to the revenue basically to grow about this much. So yeah, it's, I don't know, but it doesn't look great at all. Current ratio, current price, we're looking about 257. Fair value 260 right now. Simply Wall Street is saying basically just 1% undervalued at the moment. Fair valued for fair value price according to Morningstar is $310 per share, and it's like about 17% discount right now. According to Tip Ranks, is actually $294 per share, and that's about 14% upside. According to them as well, it says it's a moderate buy. In terms of total revenue, we're looking at about $4.4 billion to right now 5.9, which is not bad at all. In terms of cost, it can stay consistently. Gross profit 3.1 to right now 4, and then the net income 1.3 to 1.7. EBITDA 2 and right now to 3.2, so 2.0 and to now 3.2. Free cash flow, we're looking at about 1.3 to right now 1.2. So there's a decline in free cash flow. So that means maybe something is going on with this company that we need to investigate a little bit more. If you own it, that will definitely look at their latest 10K, look at their earnings report, listen to their earnings call, and find out why there has been a little bit of decline in terms of free cash flow, and see where that money went. Okay, have they actually basically written off some debt that they had, whatever the case might be. But the good news is they are actually buying back their own shares, unlike the other company, right? And finally, the final thing we want to look at in terms of their financials, how Sharia compliance side of things. So 100% in terms of business activity screen, in terms of the debt, about 16.4 and 3.14, which is absolutely fine. There you have it. Two great companies, but one I definitely own in my portfolio, and I've already said this as well before. I genuinely do prefer S&P Global. Moody's is one of those also great companies. It's got great financials, but the thing is, I don't know where they're heading in the next 5 to 10 years direction-wise. So for that reason, I am not investing in this company anytime soon. If things change, obviously, is one of those companies. What's his name? Warren Buffett owns in his portfolio, and he has quite a bit of it as well. So there must be a reason, or maybe he bought it when it was the stock price was like $100 per share or whatever, right? And he's actually sitting there with a lot of capital gains and getting dividends and so on. So there's a reason for it. But to pay this much for a stock that's right now they're not expected to grow that much, I would be a little bit hesitant. Whereas 10% growth in this company, right? And right now seems basically either it's got about 18% discounted right now according to Morningstar. And the financially looks absolutely a lot more healthy. They've got a lot more free cash flow. Okay, dividend seems okay. They might increase that dividend. And when it comes to PE, it's only 23. I know the market is now below than that, below this. Okay, the S&P 500. But at the moment, this doesn't seem too expensive in comparison to this company, whose future might be actually a little bit gray at the moment. Anyway, that's my take on these two companies. If you are still here and watching, please give the videos a like, subscribe to the channel, let me know. And what I'm planning to do is hopefully buy another share or two in the next few weeks, just to kind of, maybe I'll just buy one more just to round it up to 5 shares and then see how it goes. And if it keeps coming back down, I'll probably add more to this. I've got another video planned up to probably release it today or tomorrow. So if you're enjoying the content, please like the video, subscribe to the channel. Have a wonderful day. Assalamu Alaikum.